Good morning, everyone, and welcome to our annual property briefing for Discover Financial Partners and Rees Group. This year, we're taking a slightly different format because we're bringing it to you via Zoom, not the RACV Club in the CBD in Melbourne. Thanks for taking the time to have a look at our presentation today. We have the pleasure of Adam Murchie from Forza Capital joining us again. Adam, I think what is probably the sixth or seventh year. I've lost track, to be very honest with you. We do have a disclaimer that we're going to put up for everybody just to understand that the information that we're running through today is of general nature. If you need specific advice, you should seek that. So I'll get the disclaimer put up if we can. Also joining us today is Matt Gibson from Discover Financial Partners, and also to one of his partners, David Mefford. And I'm Justin Mastoris from Rees Group, as some of you may already know. So I can just have the disclaimer up. We'll pop that up. There we go, everybody. And we'll go to the Zoom view so everyone can see the panelists, the four of us on. And Adam, welcome. Thanks for your time today.
Thanks. Good to be here again. I think it's actually year 8, Justin, from memory. So time flies when you're having fun.
Fantastic. Why don't you maybe start off just giving us a bit of a rundown of the last 6 months for Forza. I know that you've had an opportunities fund that you've raised some money for, and just tell us what you're seeing in this COVID environment at the moment.
Sure. Yeah, it's probably a little bit of a two-speed dynamic at the moment, Justin. So on our Forza priority framework you mentioned, we went out to our client base. I had a bit of a thought bubble in April that we'd been around this sort of market dynamic before, and we understand that being ultra competitive is what creates the best opportunities. So we thought we'd go and speak to our clients about raising some opportunistic capital to sort of take advantage of some of the dysfunction that we expect to occur. Now, as I was saying to you earlier, I sort of would have been happy at about $100 million, or that's what I was targeting initially, and we ended up at about $240 odd million of committed capital. So there's no shortage of money out there, and we're not the only ones saying that. And I think governments have stimulated the markets over the last few years with huge amounts of liquidity. So we expect that to flow through in terms of investments, and that's what's one of the headlines in the paper today, that any adjustment's not going to be capital led; it's going to be income led. So we think that that's just a byproduct of it. But in terms of the actual market itself, the real answer to give you is nothing. There's absolutely nothing happening. There's very little transactional activity. In fact, I think the stats are hotel activity is down 80%, retail's down 60%, office is down about 50%, and I think even the golden child at the moment of property being sort of logistics and infrastructure type plays is down about 35%. So the whole market's sort of in a bit of a hiatus at the moment, and it's probably as much as what's not happening as what actually is happening. So that's a function of the whole sector's in standstill. So people are renegotiating rent deals, people are seeking rent relief. No one wants to come to the market to realise an asset now if they can avoid that. So this is literally the manifestation of a can getting kicked down the road, if you like.
So it sounds like, I mean, with that being the case, that if you're making investment decisions, you've almost got to form a view of what, I know we were talking to a fund manager yesterday, and they're talking about how they need to form an opinion about a company as to what it'll look like 3 years from now, not what it looks like in 6 months, because we don't know in the short term. So is there an element of that being your approach when you're thinking about where you want to position for looking for deals in the property space over the next 6 months to 3 years?
Oh, without doubt, Matt, without doubt. And I'll give you some, I'll provide some colour to that. So let's take office. I think it's probably the one sector at the moment within property on everyone's list. Is office dead? Our view is no, it's not. The format of it will change slightly, but we don't think that the change is likely to be as material as what everyone is probably thinking about at the moment. And from a statistical point of view, the market had already been going through a bit of a transition over the last 20 years. The workspace ratios per employee had been compressing. And what I mean by that is, back in the sort of 1980s to 1990s, it was sort of one person per 20 square metres, and it's now compressed to about one person per 8 square metres as an average in sort of 2019, 2020. And that market had already started to push out. People realised that that was sort of the office version of a chicken coop, and that you had people on top of people and that they didn't necessarily have fixed desks. So that was already starting to push out to sort of circa 1 to 10, one person per 10 square metres. And now off the back of COVID, if people are starting to want social distance in an office, well, that's probably going out to 1 to 14. So what that means is that you can relocate, 20 to 25% of your office space and still need the same amount of, your office employees and still need the same amount of office space. So we think there's going to be a rejigging of office. I think if there is one change, the thing that seems to be coming out of it at the moment is that people will probably work or seek to work 1 to 2 days a week at home and the balance in the office. But on that dynamic, I don't know how you can actually reduce your office footprint. So if we say that on that basis, demand is probably robust or largely the status quo, then the knock-on to this for us is where it gets really interesting. So there is a lot of noise around office, no doubt. There is going to be vacancy. There are tenants that are going to go under. There's no doubt about that. And we're seeing it at the coalface in terms of assets that have got vacancy already and hearing about tenants that are in a spot of bother. And in any environment where there's confusion, there's risk associated with that. And then when there's risk, there's discounts associated with assets with perceived risk. And that for us is the holy grail, because we think in this office dynamic at the moment, there's perceived risk everywhere. That will temper pricing in some areas, and particularly there'll be a greater demarcation between prime assets and secondary assets. So at the moment, there's some data in the financial review today that Forza Capital Analytics were saying that they looked at Tokyo's market during the last correction in an ultra low interest rate environment to work out whether the price of prime assets would actually correct. And they said that basically they did nothing, but that is they stood still, but secondary assets shifted. And that's what we expect to happen again here now. And that's really, I suppose, where a bit of an art form comes into the area in which we play. We typically focus on that secondary asset space, and the rationale being that in an environment such as now, the gap between pricing of A-grade assets and secondary assets increases. But when the market starts to get a tailwind back and the demand side of things comes back into flavour, the pricing differential between the two dissipates. And basically, at the early part of this year, there was no price gap. Prime and secondary assets were priced the same. So if you understand how to play that sort of cycle and those amplitudes, that's where you can make some really interesting gains. But you really need to understand those sectors and be able to get the hands dirty. So that's for us a dysfunctional, turbulent environment where there's arguably assets that are mispriced is what we're looking at. And we don't think that all office is created equally. There'll be some that really will be distressed and should trade at distressed prices to compensate for the risk. But there are others that we think are probably being tarnished with the brush unfairly. And they're the assets that we're sort of really looking at the moment. And if you actually then take that thread, Matt, and take it out longer term, we think that office has got a really interesting dynamic because supply is going to come to a grinding halt. That's undoubted. It always does in these cycles. It has had a fairly full supply cycle, mind you, and that's sort of influencing vacancy rates a little now already. But you see it always that the supply side drops off a cliff. It takes years for the demand side to recover. Once that recovers, it also takes years for the supply side to come online. And what happens in the intervening period is rents increase. The reason being, economic rent needs to increase to a level to justify new development. And we think that will be exacerbated further still this time around because over the last 10 to 15 years, a big part of the economic return that you were obtaining was being derived from consistently compressing yields and cap rates. Now, I think there might be a little bit of compression going forward, depending on what happens with interest rates, but that cycle's largely played its hand. So therefore, all of the heavy lifting next cycle in terms of economic return is shouldered by rents. So that means that rent growth in an arguable sense needs to be quite significant second time around. So we're looking at the dynamic at the moment saying you can buy assets with a little bit of risk, but potentially they're being mispriced. Net effective rents have fallen because incentives for leases are increasing. That for us starts to look a little bit sexy because you can buy assets reasonably cheaply, you can reposition them, you take a longer term view, and you can see the market dynamics actually giving you some fairly interesting and quite attractive investment returns on a relatively sort of benign risk profile. So that for us is sort of the holy grail of investing, how you get outsized reward for quite low risk.
Well, that's the, I guess that's the reward of contrarianism, isn't it? That while the crowd's sort of moving one way, there's opportunities always emerge. And we're looking at this example of that in the share market yesterday with the difference between the oil prices obviously through the floor and the iron ore prices through the roof. But everyone's chasing the iron ore stock, not the oil stock at the moment. So, and is that the right way to go? Well, I guess time will tell, but I mean, often there's a lot of opportunity in buying the thing that's maybe unjustifiably cheap at the moment. And it sounds a bit like it's an element of your strategy.
Oh, it's always been our strategy. I mean, it's well known that we were really struggling to find things to buy at the back end of last year and early this year. And to an extent, we still are. I mean, the pricing adjustment in a lot of areas still hasn't occurred yet. I can give you an example of one transaction that we bid on that we bid $90 million, didn't even make the second round. They ran with offers of over $115 million plus. So we're still in some cases 20% off the mark, but that's fine. That will be the case. We don't need wholesale market capitulation either, mind you. You only need the right asset at the right price in order to create a good opportunity for oneself. So it's more just scouring the market and looking at interesting deals, and they are slowly starting to present. There's one that we're looking at the moment where it needs a renegotiation with the existing tenant, but if you can do that, you can acquire the asset quite well, and the vendor needs a solution because they're getting some pressure to settle existing purchases that they've made. So therefore, they need to divest this asset in order to conclude that. So, and there's another asset we're looking at where the vendor is quite high profile, and we've been told he's been not so subtly tapped on the shoulder by the bank and told to redeem his asset position by the end of the year. So these sort of things are slowly filtering through. Bear in mind that even the banks have been on a standstill, and probably still are, at least until the end of this month, and depending on where you sit in terms of Victoria, New South Wales, Queensland, possibly until beyond the end of this year. So there's still some dysfunction within the market that's preventing, how would I put it, normalised conditions prevailing. So therefore, one still needs to be patient. Now's not the time to go rushing headlong into the market. Contrarianism, I agree with you, is pretty important, but you just sort of need to understand when to readily apply that logic to the investment class. Yeah,
sure. And I guess the other big issue that seems to come up when we're talking to clients about property, and particularly the commercial spaces, is retail, and I guess that's always seen as a bit as an area that I guess the consensus from clients is that there's potentially, is there no opportunity in that space anymore. Be interested for you to sort of paint a picture of where you see the opportunity, Adam.
I think retail looks interesting. It's going through a complete repositioning and a rebirth almost. I mean, retail has slowly been going from a selling-based, I suppose, platform to a services-based platform. And that's been happening through high street retail and shopping centres for a long period of time. The current dynamic has supercharged that. But retail is not dead. Retail is just going to change its form slightly. And I think what you'll find with some of the selling side of things, particularly where they've been able to shift themselves to a significant online presence, and that's worked well for them, is you'll see a little bit of a shandy between industrial and retail, where you will have retail outlets associated with a distribution warehouse. So some of those tenants will move from traditional retail locations. Others, I think you will see just the nature of the mix change, and these centres become more of a services hub. We actually think some of these retail sites become interesting from a total repositioning play, in that they have, in some, think about some of the sort of sub-regional shopping centres, neighbourhood shopping centres. They often sit on large land masses, the bulk of which is car parking. Yet you're deriving still an income return across the whole land mass, whereas the actual retail component is often only sort of somewhere between 25 to 50% of the land piece. So arguably you've got large development sites or repositioning opportunities. They could be office, they could even be residential. So we think that there's probably going to be a little bit of a rehash with some retail. And then if you look at high street retail, we think some of those will be repurposed into smaller style office or almost co-working type hubs. They're generally well located, good public transport and social amenity and other good infrastructure around that. If you have a view on that there's a bit of a decentralising in some areas of office, that could well support that. We don't believe, by the way, that there's going to be this mass office decentralisation. When you look at cyclical adjustments, it actually tends to do the reverse, that people for the same dollar spend on rent can upgrade their space to areas where there is better infrastructure, so they tend to go to CBDs. But we do think there's probably going to be a little bit of sort of improved demand in, how would I put it, fringe areas. And retail, or the repositioning of some of these retail assets, will play a big part in that.
So just on the fringe issue there, Adam, how about so city fringe office / as you're saying, sort of retail co-working spaces, and even suburban? What are you guys thinking there?
Well, that market's had a shot of adrenaline, and they've probably got a hangover from it at the moment. So take that sort of Cremorne South Yarra market. I think at the moment they've got about 80,000 metres of stock being speculatively built with no pre-commits. And I saw a stat this morning, there's about 305,000 square metres of supply in that market. And I think Ash was telling me the vacancies have already gone from sort of about 6% into double digits in the last 6 months. So that market's not without its own risk, that a lot of supply has come into a market that is not that deep. And that, yeah, they're good markets, but they need an equilibrium, and some of them have probably overshot the equilibrium a touch. We have heard a couple of sites that were sort of mooted supply have or are coming to the market, so there's probably going to be a little bit of a rebalancing there. But we think, you know, the Cremornes, the South Yarras, they're always going to have demand, but they always have historically in any event. It's just that, you know, there's sort of shifts in how those supply and demand metrics actually occur, and Cremorne probably got a little bit crazy around the tech side of things, but it will play its own dynamic in time, and that market will balance out. But I think, you know, short term in that space, they're probably facing significant shifts in tenant incentives, which will have the effect of actually reducing the net effective rent as a landlord. So, yeah, I would think that there will be some price adjustments in those sort of markets shortish term.
Yeah, interesting. I mean, you certainly see all of the building going on, and it does sort of make you sort of scratch your head as to how they're going to fill it. So, yeah, I guess we've seen.
But even in our street, Adam, there's 2 years ago was an auction of a very small sort of little office, and the investors were standing next to Matt and I as we're watching the auction, and they had their little yield list of what they were going to buy this asset. It's about 200 square metres. It's not huge, and there's already been 2 different tenants in that property, and it's vacant at the moment because, you know, with a 4 lease sign on it, because they bought on yield. They thought they were just buying, you know, money for jam from a return point of view, and sure enough, that's changing. So,
well, that's probably a good segue in some respects to where the opportunities in property will be derived from over the next little bit. In that, there's probably this two-speed economy that you've got larger landlords, larger tenants that have been quite proactive at the moment in recognising that the tenant is king and that vacancy will destroy you. So they've been very tactile and hands-on in negotiating with tenants to extend their position. Sure, short-term it costs a little bit because you probably have to incentivise them to extend their lease, but it's a very cheap insurance policy. Conversely, there are some of these smaller tenants that have bought on yields, Justin, and they've probably paid pretty full price. They don't have capital reserves. They've now lost a tenant. They don't have any income to throw at the asset. How do they dig themselves out of the pickle? Well, shortly that the banks will be tapping them on the shoulder saying, well, you need to do something because you're now impaired. That's sort of where the opportunity set comes through. And we think there's a lot of people in the market that have taken their head in the sand approach. They've just decided to kick the can down the road and hope, the old hope-based strategy, hope that somehow things get better. We don't think short-term they necessarily will. And this is where you'll start to see the divide come into the marketplace, that those that can have been proactive and shored their assets up, and those that can't, probably this is where the distress starts to manifest. I can tell you from our Forza point of view, we've renegotiated nearly every lease across the entire portfolio. It hasn't necessarily improved asset value. In fact, in some cases, it's conversely impaired the value because the asset value has remained the same, but when you deduct the additional incentive cost that we've negotiated or provided, that sort of reduces your net valuation position. But our view is cheap insurance policy, time and place. With time, that will play out. You can't afford to have vacant space at the moment. You'll be savage. Not only do you not have any income, but the cost of then acquiring a new tenant is going to be prohibitive. So we're seeing that across the board at the moment, in that a lot of people, where they have the capacity, have been pretty tactile in negotiating with their tenants, and that, I think, is really the only strategy you can deploy at the moment, because the alternative doesn't look great.
And just on the Forza properties, any other insights into just how the composition of your tenants are holding up as far as the industry exposure?
Broadly, it's actually been really good. We had one asset in Adelaide that was a retail. It is a retail showroom, and we were sort of a little concerned about that business just being retail facing in nature, and it's a single tenant in that asset. That tenant has actually been sensational. They struggled a little bit sort of March, April, but they've worked hard. We obviously came to the party and gave them rent relief to help stabilise them, and their sales have actually been really good. And they've been actually really pleasurable to deal with, in terms of they've been very open with us, as had most of our tenants, by the way. And we've negotiated arrangements there that have supported them and supported the fund. As I said, across the spectrum, we've renegotiated the bulk of our leases. Broadly, the tenants have been very good. We've only had a couple of tenants that have met the mandatory code of conduct, and primarily that's one asset here in Melbourne. But again, we're quite happy. There are other tenants that are in the wings if those if the incumbents fall over. But thus far, we've found the tenant base has been pretty good. But again, I'd like to think that goes to the level of homework that's done before an asset is actually acquired, in that buying an asset well is one thing, but you need to make sure that the tenant covenants there is also, they're also very strong, because at the end of the day, they underwrite your asset value. If they're not there to pay rent, well, you've got some significant problems. So yeah, we've been pleasantly surprised. We were a little nervous early on. We sort of were in constant engagement with our financiers and our funds. I think it was the March quarter, we held back distributions across a couple of the funds just to build a beachhead. A couple of those, since we've been getting 100% rent and we didn't need to hold that cash, we've distributed out. A couple we've sort of kept the firepower up the sleeve as a just in case, but thus far we've seemed to have navigated things reasonably well. But again, in this environment, I prefer to remain pessimistic than optimistic. It's not the bus that you see that you get hit by, it's the one you don't see. So you sort of always keep looking over your shoulder is the mantra, I suppose.
Oh, that's great. Oh,
Yeah.
good.
And are you guys still?
Sorry, you go, Justin.
No, it's all right. Are you guys still looking interstate? So, you know, what's happening in Queensland and New South Wales at the moment? I know you've had assets that you've purchased interstate before.
Yeah. Well, I mean, their markets. Sydney's probably the market that's taking the most pain at the moment. Their vacancies increased from about sort of 3.5% to just shy of 6%. But they've got about another 3% of a vacancy that's not reported on, which is sublease space that's available. So that their market sort of looks interesting. Brisbane's actually reasonably stable at the moment. The other market we've been looking at for a while now is Adelaide. Adelaide's reasonably stable as well. We're looking at some things in Adelaide at the moment that are sort of repositioning propositions for a host of different reasons. But we've kicked plenty of tires at the moment, Justin. We haven't really seen anything that gets us super excited. Put it this way, we've sort of been doing cursory modelling on a number of deals, but all of it's gone into the recycling bin thus far. So at the moment, it's as much about keeping ourselves game ready as it is for when the game really starts, as opposed to looking at transactions that really tick all of the boxes right now. So we're canvassing the markets. It's still a little too early to tell that those details I provided earlier about the lack of transactional activity. You sort of need to see that normalise a little in order to understand the reality of the market. At the moment, it does feel a little bit like a false economy. Therefore, we're really, if I was to surmise as to what we're doing at the moment, we're trying to speak to as many people as possible, whether that be agents, valuers, investors, other participants in the sector, that just so that we can get our knowledge base where we think it needs to be. That being up to speed with information that will basically put us in the best position to understand when opportunity presents. Until then, we just need to stay the course, sit on our hands a little, I suppose.
Well, I think it's the John West approach is certainly what our clients like about what you do at Forza, and the fact that you do say no to so many deals that make it to the due diligence phase, I think is a real tick, especially when you consider how much capital you've got sitting in the wings ready to invest. I mean, it's be tempting to go and chase an asset, but clearly you don't do that, and that's really to your benefit, and it's certainly why we like what you do.
I had uncomfortable discussions on that, so the best way to deal with that is avoid them.
Yeah.
Don't get crazy on your investment.
Yeah, sure.
Hey, we've only got a few minutes left, guys. So, Adam, is there any stats around the resi market or what they're projecting for the Melbourne and Sydney residential market? You know, with the apartment supply and all that sort of thing.
Well, bear in mind the apartment. I think one of the topics that we discussed at the last session in October last year was that apartment supply had fallen off a cliff. That's not recovered, and in fact, it's probably the supply side has been tempered a little further again. So I think developers with existing product are probably taking a little bit of price pain at the moment, that they need to sell stuff at a discount to get that away. Broadly speaking, we don't see wholesale capitulation across the board. You might see some short-term resi price adjustment, but the supply-demand metrics still look reasonably benign. The big question is what actually happens with international migration, because that's the reality of the situation. Is that is what's driven markets in Australia, particularly Victoria. We've got the vast bulk of that net inbound migration over the last decade. So, one of the best ways to explain that was I was chatting to a friend of mine who's quite senior at one of the universities, and he says they are absolutely bleeding, that their income streams are so tied into international students, and that's just fallen off a cliff. So RMIT is selling their office in the city at the moment. Swinburne has got theirs up for sale. So there's already asset sales coming from these unis. And that's the coalface for what's happened as the result of the reduction in net inbound migration. Now, it's all a function of the volume, because the huge numbers was clearly driving our market along, pretty heavily. So I think we're in a normalised environment at the moment. The question becomes if and when that dynamic shifts. But we're not sort of looking. I'd be surprised if we were seeing 20 and 30% falls in residential. I'd probably like yourselves. It's for me just a bit of sport watching some local pricing. In my street, I've got about four houses coming up for sale, and I was chatting to the agent. And I said, "Have I missed something? What on earth's going on here?" And he says, "Mate, it's age. It's people transitioning." My next question was, "How does the pricing look?" And he said, "The pricing's actually holding up reasonably well at the moment." So there's just, again, even in the resi, mate, there's just been no supply. I mean, it's about sort of 15 to 20% of what it would ordinarily be at this time of the year. So it's sort of nothing other than an educated guess at the moment.
Mm.
David, any questions from yourself for Adam?
No, I think you've answered most of it. It is interesting. I think it sounds very similar to the share market in the sense that it's a bit dislocated, and you need to think about the different assets. So, no, I've found it really interesting what you've discussed today.
Well, it's sort of looking at the behaviour side of things too, in terms of what drives. I mean, take the share market. I watched that out of interest, but the impact that the mum and dad investors have had in the market at the moment, and in particular stocks, is just phenomenal.
We've seen a few of them flying. We saw Snowflake last night go up by 120% on listing. So
Snowden, Teslas, and the impacts of the Robin Hood. It seems to be that people can't gamble at casinos or on sports broadly at the moment, so they've gone gambling elsewhere. That's been seen in terms of fourfold increase in retail trades via the ASX, and they're in stocks that people know, that they're touch points that people use them. And I think that's a good analogy to use for property too, because that sort of behaviour tends to influence other markets, and you need to understand the impact of that because it has risk attributes that need to be taken into account. Now, we're certainly watching that to try and understand where the capital flows are going from and going to, because that will sort of determine where to be looking and where to be avoiding.
One final question, Adam, for you is just apart from immigration, I was just thinking curveballs and what's the bust that you guys might be looking out for or know that it's coming behind you. Obviously, the immigration issue is a big one for the whole of the country. Is there anything else that you guys are sort of cautious of?
I think it's always the response of financiers in terms of just where they do have impaired clients, how those matters are dealt with. If assets are pushed to the market quite quickly, then that's got issues. We've heard thus far they seem to have been applying the sort of kid gloves type approach, trying to work people through that. But that for us is where the bus comes from at the moment. And then the other side of it is, I think, tenancy risk. Irrespective of the type of or the style of asset, tenancy risk is the bus at the moment. I think in a lot of cases that you just need to understand how robust that tenant's business is and how good their balance sheet is, because if they're not there, how do you replace them? So that's probably the bus that you partially can see, Justin, but it's also the one that might run you over from behind too if you're not looking around enough. And I think that's probably the bus that's hit a number of people in the last few months and certainly into next year. I think the zombie business side of things is real and present. A lot of, I think, enterprises, and I'd love your views on this, given you're in the accounting business, how many people do you think are still in operation to collect subsidy checks? And once that stimulus is gone, when do the shutters go up?
And that's, well, it's interesting you asked that question because we were talking about this yesterday in a briefing, and I said really November, December, there's going to be a lot of pain when the money dries up from the federal government. You're already seeing vacancies and businesses closing down. We're lucky we don't, across Discover and Reese's portfolio clients have many people in hospitality, but I really do think that hospitality and travel area is going to hurt a lot. And even some service-based businesses where people, when whether they're architects or whatever, they might have been committing to a large project that's been now pulled back. So I think the real pain is in the next 6 months from October onwards. So the idea is, keeping balance sheets strong. That's what we were talking about yesterday, and making sure you can ride out a bit of a storm. The ATO is pretty lenient at the moment, but that'll change. So, that's all of a sudden people have been on this, repayment holiday, if you like, for a lot of businesses. But I think we'll soon see in the next few months.
Yeah, and that's I suppose the bit we're trying to reconcile, that you have a 7% fall in GDP last quarter and the market went up. There seem to be these sort of asymmetrical responses at the moment. Eventually, though, someone best described the current circumstances to me as gravity. You can avoid it for small periods of time, but you can't avoid it forever. And eventually gravity prevails. And if what you're sort of talking about, Justin, and what we've been seeing at the coalface is reality or gravity, if you like, eventually that's the bit that plays through in the market, but it takes time. And that for us is, I suppose, why we're sitting on the hands at the moment, that if you don't think that the market has full or the right information, or certainly that conditions are normal, then you sort of need to hang out until they are. Otherwise, it could be very easy to jump at something that looks like a good opportunity now, and then to realise that you went a little too early.
All right. On that note, we might wrap up, and thanks everyone for watching. And Adam, thank you for your time at this stage. We hand across a bottle of fine red wine, but unfortunately we can't do that at the moment. But we really appreciate your time and your insights. Matt, thanks for your time also, and Dave for your inputs. And we look forward to hopefully our briefing next year is face to face, but you never know. So thanks again, and have a good day.